Great. Well, thank you, and good morning, everybody. This session's topic is Hong Kong as an international asset management and risk management center, opportunities and challenges. In my 30-plus years in the asset management industry, when I visited Taiwan, Korea, Japan, Malaysia, India, etc., I was often asked, what do these markets need to do to become a regional asset management center? And my answer usually took the form of, well, what exactly is a regional financial center when it comes to asset management? And my answer is a very simple one. I believe that when people from country A want to invest in country B, but they take their money through country C to do that, then country C is a regional or global financial market. So, for example, if a French institutional investor wants to invest in Taiwan, and they send their money not to Taiwan, but they send it to Hong Kong, then Hong Kong is a regional financial center. And conversely, if a Taiwanese housewife wants to invest in France or invest in Europe, and she doesn't buy a fund in France or a fund in the UK, but she buys a fund that's organized out of Hong Kong, then Hong Kong is playing the role of a regional financial center. So I tend to use this country A investing in country B going through country C as a sort of litmus test as to what a regional financial center is. And when you think about it, there are very few markets like this. When people in London or Madrid or Stockholm decide they want to invest in Korea, they rarely send their money to Taipei or Manila for management, right? And if a Japanese investor wants to invest in Europe, they don't tend to buy a fund from Korea or Indonesia, but they will often buy a fund from Hong Kong. And so Hong Kong's been very fortunate since the early 1970s, actually starting in 1970, to have been a regional investment management center. And so today when we look at asset management and risk management, we tend to focus on questions like, how can Hong Kong help investors from Europe, the Americas, or elsewhere who want to invest in China or other Asian markets? And how can Hong Kong help investors in China or some of the other Asian markets to invest into the rest of the world and invest globally? Why should they funnel their investments through Hong Kong? What are the opportunities? What are the challenges? And today, to help us dissect that topic, we have five true experts. And starting from our right, Dr. King Au, who is Chief Executive Officer of Value Partners Group Limited, a leading Hong Kong-based investment management firm. Ms. Christina Choi, Executive Director of Investment Products at the SFC. Professor Liu Mingkang, BCT Distinguished Research Fellow at the Lau Chor Tak Institute of Global Economics and Finance, and Honorary Professor at the Business School at the Chinese University of Hong Kong. And Professor Liu is probably better known to many of you as the ex-chairman of the CBRC in Beijing for a decade. And Mr. Brian Di Rosario, Chief Risk Officer, Asia Pacific ex-Japan for Morgan Stanley Asia Limited, and Mr. Keith Louie, Executive Director, Supervision of Markets at the SFC. Thank you all for taking time today. Pleasure. I'd like to begin with Professor Liu, if we could, as someone who has regulated the financial system in China for a decade and who is a keen student of the financial system globally. Could we ask you to set the scene for us? Why is this an important topic?
Okay. Just very quickly, and to mention a couple of things about opportunities and challenges of asset management industry. In my eyes, the global asset management industry is already outpaced the GDP growth the whole world. Globally speaking, is 6% something increase annually on average, and in mainland China is 16%. Asia will be a region of growth continuously in the future, because if you think about 60% of the population, but only under 15% of global AUM, asset under management, and China will see spectacular industry growth in that regard, because it's 1.4 billion people, and it's but just a little bit less than $3 trillion US dollars AUM. It's only 3% something of the world. and China A-share inclusion in MSCI indices starting May and August respectively, and will increase portfolio allocations into the mainland, in my eyes. And Stock Connect and the Bond Connect will be another story. And the Hong Kong and China mutual recognition of funds will be opening a new era. And Hong Kong always has its unique advantages. As everybody knows, it's a rule of law, professionalism, and also the asset management infrastructure. It's well-developed and transparent, and easy access to the markets of the mainland. Global investors nowadays are underinvested in mainland China, and will play catch up, and Hong Kong, with all its strong points and advantages, especially a large community of English and Chinese speaking professionals, and can facilitate bridging the gap for us. And the biggest upcoming event in my eyes is Chinese domestic bonds. Sooner or later will be included in one of all the three of the global bond indices. Might lead billions of investment inflows into China, and most of them will be via Hong Kong. Challenges. The migration from actively managed to passively managed, like ETFs and so on and so forth, and the management of fee compression is one. B is consolidation, M&A, and asset management industries, and the AUM concentration. It's quite conspicuous. The top 25 managers control almost half of AUM, while 250 managers, managers owning 6%, less than 6%. And AUM also are chasing small number of stocks. For example, 3 stocks, Tencent, AI, HSBC here is half of the pie. And Hang Seng Index gain last year. Top 10 stocks is 81%. The very large concentration and exposure. And this year, in my eyes, will be a year of market turbulence, global interest rate normalization, and not to mention the increasing volatility attached. So, finally, 2 questions. How well are we adapting? Are we ready? And the second one is, how well do we know each other? Thank you.
Well, thank you, Professor Liu, for setting the scene for us. In Hong Kong, we have 1 country, 2 systems. This morning, we have 1 panel, 2 topics. So we will be jumping back and forth between asset management and risk management, and we'll start with asset management. But before I get us started down that path, I would just highlight, we do plan to leave as much time as possible for questions, about half an hour. And so it would be useful if you got your questions in sooner rather than later, so that I can get them and digest them and be prepared to ask those questions when we get to about the 45-minute mark. Asset management. In recent years, Hong Kong has launched numerous cross-border initiatives, mutual recognition of funds, Stock Connect, Bond Connect. Christina, how's it going so far? And how are we doing?
Thank you. Actually, the SFC has been actively pursuing a arrangement, a strategy of having mutual recognition arrangements to expand the distribution of the funds market here. And I think the major breakthrough was the 2015, the arrangement with the mainland, CSRC. And actually following the launch, we have today altogether authorized 61 funds under the scheme and recorded close to 13 billion RMB net cross-border fund flows. And actually, it represented a 60% increase from 8 billion RMB as of the end of 2016. I think in particular, I want to mention that the sales of southbound mainland funds, it's not, okay. Okay. I hope I don't have to repeat what I said. Actually, I just mentioned that actually, so far the scheme has been operating smoothly. Altogether, we authorized 61 funds and recorded close to 13 billion RMB net cross-border fund flows. And it was a 60% increase from 8 billion RMB as at the end of 2016. And in particular, the southbound mainland funds were gaining some traction in 2017 with aggregate net sales amounting close to 340 million RMB, which was 3.5 times the amount recorded in 2016. So actually, with the stabilization of capital outflows and more optimistic outlook of the renminbi and the Chinese economy, actually we have seen more Hong Kong MRF funds approval from the CSRC since last year. So we are, seeing more interest and more funds being approved. And I think I would like to stress that it's important that, this is a long-term project and we have to seek mutual benefits for both markets and a step-by-step approach, because I think, as you all know, since the summer of 2015, I think stability and risk controls are top priorities for the mainland securities regulators. So I think, we have to actually understand the situation in mainland. But I think an important, illustration of the importance of the scheme is that actually recently the CSRC has announced that actually the mainland private pension funds are permitted to invest in MRF funds from Hong Kong. So actually this is a testimony of the importance of the program, to the mainland authorities and also to this industry. I think, we have 300 billion renminbi quota, for this scheme, and only about 5% is being used. So actually, I would urge the industries to make very good use of this program, and actually there is a huge opportunity and potential for global managers, because actually for the scheme, unlike some of the maybe CIPR or other scheme where you have to define what is a Hong Kong manager, and it could be quite a challenge because we are a truly multinational platform and really hosting firms from different ownership and backgrounds. But actually for the MRF schemes, as long as you are authorized by the SFC, you are eligible, subject to a track record and a size of investment. So I would urge the industries to make good use of the scheme. And also, I think apart from the mainland, we have concluded mutual recognition arrangements with Switzerland and France, and we are pleased to see some fund managers, especially the local fund managers who may not have a platform in Europe, are starting to use it. And I think we are also in very active discussions with other jurisdictions, and we are hopeful that we can, we hope to conclude some this year. And of course, not to mention, we are also working very hard on ways to expand the mutual market access to more products, including seeking how to, expand cross-border access to ETFs.
Great. Thank you, Christina. Now, Keith, I know this is an area you're also an active participant in. Is there anything you'd like to add?
Yeah, thank you, Blair. I think, just follow up on, Christina's, discussions. Hong Kong, since the early 90s, right, Hong Kong has been, a major fundraising center for mainland enterprise, okay? So we continue, to do that job, and we, want to, moving into another level. So the previous panel talking about the WER, biotech, they are, to some extent also relating to what's changing in China, right, in its economy, how Hong Kong can capture that opportunities, right? Now, so that's the IPO market, the primary market. But since the launch of the Stock Connect in, 2014, and also the Shenzhen Connect in 2016. I think things have changing. In other words, our relationship with the mainland is deepening, it's changing. We are moving not just from the capital raising, but to secondary market trading. When we talk about trading, then we are talking about investment. So that ties into the fund industry, right? And then that will go even further. Going forward will be when people are investing in a country like in the mainland, how do they managing the mainland risk, the investment risk? So that go into the risk management area. So when Hong Kong want to elevate our sophistication, our value chain, our value add to this whole process, I think we need to moving step by steps, right? Just like other international financial center like London and New York, they're playing this full-scale service, right, to people around them. Not people they need this type of service. I mean, for Hong Kong, our aim is how to bring the world to China, the investor, the money to China. So Hong Kong is doing that for the IPO process. Through Stock Connect, I mean, we also allow the international investor to get into the A market directly. But they also can come into Hong Kong to, get exposure to China, investments, right, opportunities. But the most interesting thing is we also bring China to the world through Hong Kong. So we have, for the Stock Connect, we have the southbound, right, link. That's the first time, the mainland open up the retail and all kind of investor to come to Hong Kong, right, to enjoy whatever product we have here. So that's why, I mean, this is a new golden opportunity for us to capitalize on this one. I mean, for the risk management, process, I think we need to focus on 4 key elements to strengthen our framework. The first one, we need to have a variety of product. We need different product. Either, stock, equity, bond, different asset classes. Plus, besides the cash market, but also derivative relating to that. The second one is, we need to build, different platforms, channel to connect the two markets, right? And connect China through Hong Kong to the world. So we have the Stock Connect, we have the Bond Connect, and we have the, mutual recognition fund. These are another type of connects for us. The third element is we need to have, good practice. In other words, we need to adopt international practice, right, in Hong Kong. We are different from the mainland, right? We are a global market. So that's why that will keep also our strength as well. So, and the last element is the regulation cooperation. I mean, in the previous panel, Ashley mentioned about that. I think that's really key to this whole process. Because when different markets link together, there will be, upside, when, both grow together, right? Win-win. But for financial market, we also need to guard against financial, risk, right? Instability. The market just has its own dynamics. So the cooperation between regulator, particularly Hong Kong and the mainland, are key to maintain this, bottom line, making sure things will be dealt with, when we are getting into some extreme situations. So I just stopped there.
Okay. Well, following up on that, why does the rest of the world need Hong Kong? If you're a foreigner looking to invest in China, or maybe other Asian markets, why should you route your investment through Hong Kong? What can Hong Kong offer that, for instance, you can't do in your home market, or that you can't do in China directly? Christina King, I might turn to the two of you first on this.
I think actually, we have, as Professor Liu actually highlighted, there are actually, Hong Kong is in a unique position. We are part of China, and yet we are an international financial center. We have the rule of law and a robust regulatory system, transparency, predictability, and I think, Hong Kong has been playing, for a long time, the gateway for overseas investors' investment into China. And I think as reflected in our fund survey, 65% of the asset under management of this business actually are sourced outside Hong Kong. So actually it is a testimony of the trust of investors overseas and locally into the system, into the expertise. We have a wealth of bilingual experts and talents here that can serve the needs of international investors. And I think as Professor Liu mentioned, actually China is still underinvested
by the global investment community. So actually, Hong Kong can be, play a very important role as the mainland Chinese expert for foreign investors.
Okay.
Yeah, in fact, I think Hong Kong has been playing this super connector role since '93, when H-shares was first introduced. That's the very reason why global investors need Hong Kong. It's not just that, we were the first renminbi clearing center. Because of that, we now have renminbi investment products. We have an offshore renminbi bond market. Now we have Stock Connect. With Stock Connect, the fund industry has benefited a lot from that, not just about MRF. As you read the latest southbound funds that have been approved by CSRC, the number has shot up quite significantly. In the early part of 2017, we got probably 1 or 2 southbound funds approved every month, but in January, there were 16 funds that were approved. With MRF, we now have access to the largest saving pool in the world. I think you have all read this fantastic news that a balance fund in China managed to raise over $4 billion US in just one day. So I think we are a major beneficiary of that, the asset management industry.
And Professor De O'Brien, is there anything you'd like to add?
I agree with what they mentioned earlier. And realistically, I think China and Hong Kong, if you can to the comparisons in the details, and I still think Hong Kong takes advantage of years of gaps ahead of China to provide the value-added services that China presently do not have yet, and to bridge the gap between the China and outside the world. Give you an example, capital account free flow is not with us. It's only partially. China is determined to open its capital account in the future, but perhaps for many more years. We got to wait. But here in Hong Kong, everything is free, okay? Any Hong Kong business then can set up its investment vehicles outside of Hong Kong at any time. And any foreigners can set up companies here in Hong Kong at any time. So Hong Kong can be both exit and entry points for China and for the rest of the world. And that is an undeniable factor. And also the market people nowadays, especially middle income class in mainland China, or the investors potentially coming from every corner of the world, what they do need information about Chinese risk profile, but China is semi-closed, okay? It's not so easy to access to information in that. So I think to Hong Kong, the real advantages is not products nourish, it's a platform. The platform of services from the sell side and both sell side and buy side, right? And you can, for example, to provide very good investment banking services, brokerage firms services on the sell side, and in the form of information, the research independent enough and the professional enough. And also the services from the buy side, the portfolio management, in-house research, and the systems and operations, and the service from the middle, and the lawyer firms, and the rating agencies, accounting firms, etc. So all these programs together, that is very valuable to the people from outside of China wishing to invest in mainland China.
Yeah, I just add from the point of view of what Hong Kong could be doing, it's doing a lot of great things. Obviously, the connect, the recognition, mutual recognition, proactive regulation. It's all moving in a very positive direction. From everything I've talked to people about coming into this, the Stock Connect obviously is a huge success. People just want more of it, and it's really about how you can make it even better. The inclusion into the index will create, again, even more relevance to the whole thing. There are pieces around it which I think maybe they start to cross over into risk management, et cetera. But questions around quota, questions around liquidity, potentially in CNH, to be able to deal with the flows that could come as this channel becomes even more critical post-inclusion. These are really big things. There's a bunch of administrative issues, I'm sure. Everyone is focused on both sides of China, mainland and Hong Kong. On the Bond Connect, again, is a very big development. Hasn't really kicked off in a big way. And I think the sense is there are more administrative challenges to deal with around technicality like DVP, questions around ratings of domestic debt for international investors, which different systems. It's not unique to China where you have local rating systems, but I think that gets a little more focus. Questions around funding, but probably the biggest piece that could create a challenge is to do with the hedgeability of debt, because kind of flowing with the size of the CNH market, you start to think about, do you really have a secondary market in interest rates? And if you start to get, again, inclusion in the bond indices and very big investment flows, then the thing that investors will really be looking for is how do you get in and out of your rate exposure in what's a very difficult global environment. And then probably the next leg up from there is how do you actually manage idiosyncratic credit risk or the spread risk associated with the bonds that people will then be long. And then you get into the depth of the CDS market and index hedging, et cetera, which are all areas which are not that developed at this point. And on the rate piece, I guess it's just a simple liquidity issue and lack of futures market, et cetera. So these are opportunities, and it's a bit of, as I talk to people again, it's a bit of a chicken and egg situation. As you get more investment, you'll get more secondary. More secondary, you'll get more liquidity, and it'll move. But very, very positive on the Bond Connect potential for the future and for Hong Kong as a whole. And just on recognition, very, very exciting. I think if you play an aggressive game, if Hong Kong plays an aggressive game in terms of how it positions mutual recognition versus Europe, et cetera, I think the opportunities are there really to make it a very meaningful catalyst for turning Hong Kong into a center. As it currently stands, it's I don't think there's huge volumes that have come through, and there are still questions around will you really incorporate in Hong Kong. But again, that could come, and it really is a question for how aggressive the country wants to be as a whole with really positioning Hong Kong as an alternative to some of the global centers for fund recognition.
Well, let's pick up that topic of risk management. We talk about Hong Kong becoming a risk management center. What does that mean, and what more do we need to get there?
It's a lot of these topics. I know two topics, but they kind of converge at some level. I'd say if you answered it from the point of view of risk management around, assets, which is asset management, risk management, then I'd say the obvious things you need, your lack of futures, index for China, and something I'm sure will get addressed pretty quickly. But just having good hedging ability in Hong Kong, I think, is critical, especially for China. But I would argue that there's no reason why Hong Kong cannot and should not have a broader suite of product, not just focused on China and Hong Kong, but focused on the rest of Asia. I think if you look across at the competitor that was discussed this morning, I think there's a broader range of futures that are available. There are a broader range of even hedging instruments around FX and non-deliverable interest rates, which kind of, when you're recruiting for talent, which we often are in the fixed income space, you hear frequently that the fixed income space, the talent is based in Singapore. And it's probably partially because a lot of the hedge funds sometimes go and set up there if they're focused on debt. So I think that is certainly something that Hong Kong could be looking at in terms of broadening its ambition to just include the whole of Asia and a broader asset class, including commodities in a bigger way, and more on the fixed income side. If you take a separate piece on risk management, which is more closer to what I do day to day, you're really thinking about a booking hub. So maybe we could park that for a later part of the panel. And Blair.
Okay. Okay.
I want to comment on that. Hong Kong actually is not just a super connector to China. We've been playing a very important risk management role from a policy perspective. That's the reason why we have all these connect schemes. We have X-share listed in Hong Kong for the reasons that the first panel already touched on. So I think we'll continue to play this very important role until renminbi becomes an international tradable currency, a reserve currency.
Keith? Yes?
Yep. Yeah, I mean, Brian raised some very important issues from the market's perspective, right? Because if you look at other financial centers, London or New York, I mean, they can develop their own risk management culture, product, and infrastructures, right? But when we are dealing with the mainland, right, interacting with the mainland, it's quite different stories. I mean, because we need to, if Hong Kong wants to be a risk management center, right, going forward, and being as free as in London, say, right? So, but there are some policy constraints. In other words, it will be relating to how the mainland authority consider, right, to use Hong Kong as an offshore center to facilitate its growth and development, right? Because so you will have this onshore and offshore relationship, right? And then, whether they are comfortable to allow the offshore center to develop to such extent, right, which could have, repercussion back on the onshore market. So they are very careful in managing this process, okay? So they will be moving step by steps in this process, okay? And we understand it. So we cannot, for example, the market would like to have, all type of, product, freedom, right? No restriction, things like that. But in reality, we need to work with the mainland side to make them comfortable. Hong Kong actually can provide some risk management function, which are better, being conducted in Hong Kong rather than in the mainland, right? For example, international investors, rather than everything go back into the mainland market, because they have a different market structure. For example, for the stock market, 80% of the trading come from the retails, right? Can the retail market, when the retail market interact, with the global investors, they need to, think about, how to rebalancing that, bargaining, play. So that's why, in Hong Kong, we need to be moving step by step. But our ambition is to help China to managing, or help international investors managing China risk in the way they are comfortable. And that's cooperation. That's why cooperation is the key in the whole process.
Now, the audience has been very good about beginning to feed questions in, and so I will work some of those questions into our conversation before we get to the Q&A. But on this particular topic, there's a question about OTC derivatives being key to risk management, and what is the situation in Hong Kong today, and what are our plans for further developing that? Anybody want?
First, and then Brian can. On OTC derivative, Hong Kong, this relating to, it's not just a Hong Kong issue, it's a global issue. 10 years ago, right, the collapse of Lehman, the collapse of AIG, right, part of the story was relating to their, huge, derivative positions, right, some very sophisticated structured products. So that's why, since that time, the global, the G20 Financial Stability Board, they, mandate basically, all the, a major reform for OTC derivative market. So Hong Kong, as part of the, process, we also implementing, together with HKMA, the global standard in Hong Kong. So we are moving step by step, right? We already mandate certain product to be, cleared by clearinghouses, And also there's a trade reporting, so there's a transparency to the market, to the regulators. So we will be moving into trading mandate. Basically, some of the standardized product need to be traded on platforms recognized by the regulators. So Hong Kong has been doing this quite in sync with the other market. And also, I mean, according to the BIS, the Bank for International Settlement, right, in Basel, I mean, 2 years ago, they released a survey report saying that they rank, the global, OTC derivative activities. And Hong Kong ranked, the 4th globally, right? So in other words, I mean, it's not a bad thing for Hong Kong, right? We have a critical mass. We have the activity level in Hong Kong. So I think we will continue to promote that process as our regulators. And as to relate to renminbi type of thing, of course, the larger picture as to the renminbi pool here, right? Whether the mainlands are willing to allow Hong Kong to have access that type of market, so allow the interplay between onshore and offshore. If that's allowed, then that will grow our market much quicker.
Brian, any thoughts on
no,
this?
I think OTC derivatives are not new to Hong Kong at all. I think they're very sophisticated product available to institutional clients for the most part. So I don't think that by itself is an issue. It could just be more to do with the lack of basic, futures type instruments, which are frequently kind of called out, where they're accessible more broadly to people that want to hedge. But institutional money, I think, already can access most of the protection that they want.
I might keep us moving here, and so I'm going to combine two topics that are related. One is that Hong Kong has a population of just 7 million people, 7.4 to be a bit more exact, which is a relatively small population to run a sizable financial services industry off of. And therefore, for us to run a sizable industry, we need to do a fair amount of exporting. And so there's a couple of questions related to what do we need to do to make sure that our products can be more easily exported to neighboring countries, and China comes to mind. And the related topic has to do with fintech. We've already got some questions coming in about robo-advisors, but I would lump all these questions together around distribution and distribution across borders. How do we make sure that we make it easy, efficient, and yet effective for investors in neighboring markets to bring their money to Hong Kong for management? I'm not going to pinpoint anybody, just throw it out there and see who wants to take it.
Maybe I will start. Actually, yeah, it's important. We are a very open market, and actually we have, we welcome products from all over the world, subject to, assessing, for investor protection purposes. That's why we used to be, we have been very successful as a distribution hub for European or other funds. But I think now we have to move on, and actually with the emergence of, the wealth in China and the opening up, actually we think that we should be enhancing our role as management and also the related services, with a full range of asset management, related administration, risk management, all sorts of services that comes along with it. And I think that's the various mutual recognition arrangements that we are actively pursuing across the board, and not just with China, but as many markets as is available. And I think also in terms of distribution, I think for robo or fintech, actually, it could be, we all know it could be very disruptive and is powerful, as it could disintermediate, actually, the trade and services. And I think, you're all aware of the powerful story in the mainland about some of the money market funds and also platforms. And in Hong Kong, I would say, actually, we have to be aware of the potential benefits and also the risk concerns, with fintech or this technology story. And globally, we are aware of there are benefits. It's a double-edged sword, I would say, actually, because the platforms could bring in a lot of products at a faster speed, and but then I think the risks are also there about the easy access of a lot of products, and whether we all know people can just click and buy a product at the instant without maybe talking to your relationship managers for hours, or hours would be too long. But actually, it's the speed and also the service, and what that's why we have consulted the market on the online distribution and guidelines, is to try to strike a balance to enable the ease of distribution of simple products that they could really people can make their own choice, and distinguishing from more complex products, and we have received a lot of actually quite positive feedback and support for, and there are calls for extension to non-online context. So we will be concluding it very quickly, and I think actually the whole fintech story is a big story for the market, for investors, for the service providers, and also the regulators as well. We have been thinking hard how to make use of data, or better, how it can help us on compliance or our surveillance work, supervision work. And this could be challenging because we're dealing with a lot of unknown risks as well, because the technology is global and it's actually, fast reaching. So it requires a lot of international cooperation, and we stay on top of the development of fintech. I think there will be a section later on this afternoon to talk about fintech more. But I think it's a fact that actually I know that there is feedback from a market survey that the financial industry, or particularly maybe the asset management industry, is a bit lag behind in the use of fintech. And I heard about complaints or issues about how our administrative system and all our back office system are all quite still manual, for example. So I think there is a lot of room to for the industry to think of how to make use of fintech in a responsible and considered way, like AI, robo, and how would that affect the investment solution. And we all know that actually, even if you do stress testing or historical performances on how reliable are they, because now in the last 10 years we have a whole new of macroeconomic policies that have not been seen before. So actually, can the machine or the program cope with all the scenarios?
Great,
and I think these are questions that as a regulator we encourage healthy, embrace technology development, but in a balanced manner, and you have to watch out on the risk, and not to say about, of course, all the crypto stories and issues about ICOs that have, pose a lot of challenges for investor protection and enforcement.
King, you're in the business of exporting funds.
You asked a lot of questions, so I'll try to answer them concisely. First of all, you talk about 7 million people. In fact, we've been serving the rest of the world, not just Hong Kong, for many years. So I won't repeat what I just said earlier, starting with X-shares and all that. But I think in order to continue with this momentum, we need to lead by innovation. I would contradict some of the criticism on Hong Kong, because we have been very innovative. I mentioned earlier, X-shares, renminbi clearing, now all these Connect schemes, and we're very excited about ETF Connect, and also the latest consultation on active ETF. I think because that's another way of us, as well as our global peers, bringing our expertise into China through ETF Connect and active ETFs. That's another way of addressing online distribution, because we have a lot of legacies. It's not just Hong Kong. I think that issue applies to a lot of developed markets. So, and that also is the reason why China managed to leapfrog many of us, mainly because they had less legacy. In terms of fintech, I think we need an ecosystem. We need critical mass. For that, I'm a proponent. I'm very supportive of WVR. From a fund manager perspective, I hope that applies to investors and individuals as well. Because nowadays, all these fintech companies, startups, are accessible to only private equities. And for those who have invested in private equities, the governance can be very weak because investors don't have much bargaining position. So why not bring it to the open? Allow professional investors, fund managers, or even individuals to have access to this space, providing we have the right check and balance. So I think it is a good thing. And also, without these IPOs, we won't be able to create an ecosystem, a critical mass. Hong Kong, as you said, only 7 million people. We have a very shallow talent pool in terms of IT. But if we can bring these companies to list in Hong Kong, to develop the business here as a headquarter or as a regional hub, then we'll have a bigger chance. And then also we can use that as a stepping stone to develop the Greater Bay Area, because it's no longer just about Hong Kong. Yeah.
I might just jump in for a minute in that I think this whole fintech area is very important, and I'm thinking here about the fund distribution side, not the back office side. And it's clearly an area that Hong Kong needs to tackle. I made the comment recently, I went online in the US from Hong Kong. I was able to open 2 accounts with major firms in 12 minutes. Where we know that if you're a mainlander or Taiwanese or Korean coming to Hong Kong wanting to open a bank account or buy a fund, there is a rather laborious process that takes more, usually you might say managed in days and probably weeks rather than minutes. And so I would put on the table that this is a challenge Hong Kong needs to face if we're going to be competitive long term. Because given the higher and higher fixed costs in the financial services world, more compliance, more regulations, more laws, more back office, higher costs, we cannot be competitive with a population of 7 million people. The ability to export our product to our neighboring countries, and especially the market directly to our north, is absolutely key to Hong Kong's success. But Professor Liu, I don't know, any thoughts?
When we talk about 7 million people and the fintech, this very new things and the serious reality we are facing about the population, a small community here. I think that there are 2 undeniable facts. The first is, yes, Hong Kong is just a city with 7 million population, okay? Fintech really needs and requires large investments, and only large corporations with large customer bases, and can afford to invest a large sums of money and time in R&D and infrastructures, and will have a large customer base to spread the cost. That is the vivid picture in China, in mainland China. Okay? The second undeniable fact, according to my past experience, the multinational companies, including the companies from mainland, whatever the forms they are based here, subsidiaries or branches, and they will invest everything from their home offices, right? Install the technologies and the back office over there, then export and install the technology in Hong Kong offices from their home. Not here. Yeah, in London as well, in New York and in Beijing or in Shenzhen. So as such, I think it is difficult for Hong Kong to have pure homegrown the fintech and working with, something we want to catch up. So the only viable strategy in my eyes for Hong Kong is to embrace the Great Bay Area and working with the giants nearby like Ping An, like China Merchant Bank, like Tencent, like Huawei, etc. And I think people here and in the Bay Area, we are talking about must support the concept of connectivity. It takes time, but needs a lot of cultivation and communication. And this is the real picture facing Hong Kong. We have a very good service, but how to sell our image and sell a service to the head office is remote, and to convince them to team up with them to do some cooperations, maybe in the form of many things, right? And it's timing. It's good timing for us to make full use of Hong Kong efficiency, I call it. It's a rule of law and professionalism and the talents from every corner of the world. They're happy working here. So to use that, because the control, the command, decision making are always happen with the head office and homes. But how we convince them by offering special service, tailor-made service. If you don't convinced, if you're not convinced, then we can on trial basis cross borders. We have a lot of things happen in UK, in Australia, even in Singapore. We can do that through the negotiation and with all this. I think that is the way we can embrace, and we have the guts from our side in Hong Kong to embrace the fintech, and that is the effective way out.
Right. Keith.
Yep. I mean, going back to your 7 million people questions, right? I mean, in a sense, if you look back, I mean, Hong Kong has a very, Hong Kong's GDP is around US dollar 350 billion, right? But we have our outsized capital stock markets. It's close to 4 trillion US. It's more than 10 times, right? So it's just so unique in the world, right? I mean, it just stands out when you rank among other financial centers. Why is that? Because we have two advantages. One, we have mainland provide us the candidate of listing, right? The listed company, the potential, right? Keep growing every year. Okay, WVR will be another wave, right? The other one is, Hong Kong has been, allowing international capital come in free. There's no capital control. So we combine this to create this, unique situation for Hong Kong, right? It's outside capital market. So going forward, what do we need to do for us to move up the ladders and serve, people around us is mainland. China now is the world's second largest economy. It's the second largest equity market and the third largest bond market. So if we allow the southbound flow of saving, I would say, right, they become more riches, right? There will be 400 million of middle class, are available very soon. Okay, so they need different type of investment, saving, just like any other middle class in the world, around the world. So Hong Kong if we can bring them to us through this, our platform, I think we can moving ourselves to another levels.
Well, if you think about it on the fundraising side, Hong Kong's got a double export going on, right? We're assisting firms from China and other markets to go public, and we turn around and we sell those shares everywhere from North America through Europe and so forth. So in a way, we're exporting to clients overseas, and we're exporting the IPO service to firms that are based outside of Hong Kong. And I would argue that on the asset management side, if we're going to have a very vibrant asset management industry, we have to take the same mindset, which is exactly what you're saying. We've got quite a few questions that have come in, and so I'd like to try to chop through as many of them as we can. So I'm going to start with that if I can. And Brian, I'm looking at you. The first question I've got here is, what needs to be done to better establish Hong Kong as a booking center, and what would the benefits of this be? And you touched on that subject earlier. Probably caused the question to be raised.
Very, very, very topical. Clearly, I don't know whether the impetus was Brexit or regulation, but one of the big global opportunities for financial services is to create a booking center in Asia that is away from the London, New York. London's dealing with their own issues right now and creating a European center, et cetera. So I think there is a real opportunity for large, complex financial institutions to, now this is moving completely away from the asset management topic, to, how do you create a genuine, booking center or a booking hub somewhere away from Europe. So I think that's a real opportunity. There is no, simple answer to, how you do it, but I would just, by way of a firm that's in it and grappling with these, questions all the time, it really comes, the industry is actually very heavily regulated across, the US and Europe. When I talk to my colleagues internally, they're normally weeping because a US firm booking in the UK, operating in Asia with 13 jurisdictions out of Hong Kong. So there's just a myriad of complexity that goes with running a business like that. So the opportunity really is, I'd say, some location that recognizes that it's about the cost of doing business, which is really capital. If you're equal to or less than, that goes out of the way. If you're more than that, then it's obviously expensive and it's a disadvantage. It's the ease of doing business, which is really around regulation and how cumbersome and how complicated is it to actually set up and manage a business and have a constructive, positive relationship with the regulators, which is extremely important to Morgan Stanley and I'm sure to all our competitors who run these businesses. And then the third thing is obviously the way financial institutions are going and banking. It's also very tech intensive. We're not calling it fintech, but the volumes of equity revenues that now go through electronic pipes is staggering. So derivatives are not no longer a bad word. They're very, very actively used to manage, to take positions, to defend yourself against risk, and it so really what the opportunity for some center to create a platform that is cost effective, efficient, and is actually focused on the risks that really will protect the financial system. I think in that respect, there have been a lot of very positive developments coming out of both the HKMA and the SFC to try and bring capital treatments, et cetera, more in line with global and Basel. The move to greater management accountability is, in my mind, the right focus because that's the best way to ensure that complex product and risk is effectively managed, is not through trying to do it yourself as a regulator, but it's through making sure that you create the right framework and the right accountability and the right incentive for institutions to do this themselves. And then obviously, very robust, inspections and all that kind of stuff. So I think that is the opportunity. It's very real, and I think this space will be decided in the next few years.
I'm putting you on the spot a bit. What more do we need to do to get there, and to get there rather quickly?
I think it's, for the firm, we're obviously making progress without getting too specific around some of the things relating to how something like this could be possible. I just say it's about the pace at which regulators harmonize their oversight with the global regulators, keeping in mind that the industry is already heavily regulated. So if it can be consistent, and you don't need to vary it immensely, maybe even taking the lead in terms of trying to harmonize across the broader region, because Hong Kong is not where you take your risk, it's where you would book it for risk that you're running across the region. So I'd say harmonizing regulations across the region would be huge, and then basically early adopting oversight of some of the more complex areas like electronic and derivatives.
Anybody else have anything on that particular topic?
I mean, the SFC is now is pursuing. I mean, also supports to capture this value chain for risk management, right? Booking. Booking center is one thing. The other thing is you can see the activity originating in this part of the world, right? A lot of them, right? For many years, right? Equity, whatever. But they book in New York or London, either because of different regulatory requirement, right? Different structural difference. But I think after the 2008 financial crisis, global financial reform have leveled the playing field quite a lot. Basel III, all these things, standard things, right? So I think for the firm, they need to really decide, right, from a cost perspective, whether it still need to book the regional trade in other time zones, right? And what are the pros and cons? I think for Hong Kong, we just want to offer choices to the firm to decide to using Hong Kong as a booking center as well.
And this next question, I suspect, is for Christina mainly. It's asking that other than the MRF regime, is Hong Kong actively involved in multilateral fund distribution agreements with other markets? I realize you probably can't answer that too directly.
Yes, this is about passport.
But I suppose it's passport related.
Well, actually, passport and mutual recognition, I wouldn't say they are exclusive to each other. Actually, we are quite neutral on passporting, and there is I think, Asian regional fund passport in the making. But we watch very closely, and there are a lot of challenges in terms of passporting. I think the only successful fund passport is the European users, right? And it took over 30 years to be successful.
And MRF.
Yes, and I think, we believe in MRF actually, because of the flexibility in getting bilateral arrangements with specific markets that may have maybe of mutual benefits, because we don't have a political or economic union in Asia. So actually, when you come to cross-border, export or access to products, especially to the retail we are talking about, actually it requires a very deep level of trust, mutual trust, understanding, and cooperation and information exchange between the regulators. And I believe actually Hong Kong and China, so far is we have seen some in the ASEAN as well, but I think in terms of the scale and potential, and we believe in the mutual recognition arrangements. But we are not saying no to passporting, but there are challenges like tax issues and different stage of regulatory developments, and it's quite challenging. I think probably you have more experience dealing with the passport than myself, but I think we are open and neutral, and we will be pursuing opportunities when they arise.
Professor Liu?
Yeah, I very much appreciate the neutral stand attitude towards this very important topic. Why it's important? Because I think passporting scheme here will eventually take off. But it will take a long time, because so far the standards like UCITS or CAVE, they are European standards, and it depends upon the scale of the market to use the standards. And I don't think a lot of providers in Hong Kong do make money. So, but if you look forward and beyond the boundary, the border, with the sheer size of China, sooner or later, it will be coming, because perhaps we should be more involved to establish and cultivate, talk back to the regulators in Beijing to establish UCITS like China standard in the future. This is possible because China needs this, the market needs that. And the scale of the market can afford the cost and making money from the providers. So if there's still some remaining issue uncertain, or people don't want to talk about these uncertainties, or they're not very sure about the outcomes in the future, we can talk about agreement upon the sandbox cross-border to get focused upon those sensitive issues. But in long run, this is an opportunity.
Right. Well, if anybody has questions about passports, I'm happy to chat offline. According to the clock, we've got about 10 minutes left, but we were also given the 5-minute warning about 6 minutes ago. And knowing that the only thing standing between you and lunch is when we recess this session, I'm going to make an executive decision and go with the warning rather than the clock. So I'm just going to ask our panelists very quickly, do they have any other last quick summing up comments or urgent points they wish to make? Otherwise, we'll let everybody head for lunch. Sorry, 10 minutes earlier than you thought.
I just maybe want that, we talk a lot about China, and then I'd say that unquestionably the prize for everyone is China. Hong Kong is obviously very, very uniquely positioned, and will never be replaced in that regard by any competitor. But there is an opportunity away from the China prize, which is very secure in my view, which is the broader regional opportunity. And if Hong Kong is really serious about becoming a true center, then I would personally be actively encouraging everyone to think more broadly about how we could expand products, markets, everything to include something that beyond China as well.
Great. I think unless there's any last comments.
As a regulator, I think you just need to do what's our best to maintain the quality and the integrity of our market. And then with an open mind, the opportunity will come.
Okay. Professor Liu?
Just simply put, I really appreciate Tolstoy's saying, in the war and the peace, there is no greatness where there is not simplicity, goodness, and the truth.
Well, I guess I'll make one that, I think the criticism on Hong Kong being under China influence, I think I won't take that seriously, because as we all have heard that the importance of Hong Kong being a super connector to China. So I think that status, will need to be maintained.
Okay. Well, all that remains is for me to thank our panelists for their thoughts and insights, and to release everybody for lunch. Thank you very much.
Thank you.